Let me show you a chart that is brutally honest about investing. If you've ever been tempted to chase what just worked, this is the antidote. It's the Callan periodic table of investment returns. It's a 20-year leaderboard of major asset classes, and it proves one brutal truth. The winner changes constantly. My name is Kevin Pira. I am a certified financial planner, and today I'm going to tell you why you need to stop chasing returns and focus on diversification when it comes to asset allocation. Let's go. Let's start with the most recent year on the table, 2025, because it instantly breaks people's assumptions. In 2025, emerging markets returned 33.57%, developed international returned 31.85%, and US large cap returned 17.88%. So yes, US stocks were strong, but they weren't the top box. And that's the point here. If your strategy depends on predicting which box will be number one next year, this chart is going to challenge that strategy. So here's what we're going to do today. First, I'll show you how to read this chart in about 15 seconds. Second, I'll walk you through the teaching years and explain why investors panic, chase, or quit. Third, I'll give you a simple behavior filter so you can stop making emotional portfolio moves. Let's go. This chart is a yearly ranking. Each column is one calendar year. So the top box is the best return that year, and of course the bottom box is the worst return that year. So each asset class is color-coded so you can track how it works up or down over time. And it's important to know how it moves over time because that's going to give us good insights. So here's the first piece of conventional wisdom that this chart is going to break, and it's that people think investing is about finding the best performer. This chart shows investing is often about surviving the fact that the best thing keeps changing. Before we pull insights from this chart, let me explain what exactly these things are tracking. So first, this is calendar year performance, meaning that the year can feel absolutely awful in the middle and still end up only down 10% on paper. That mismatch between what the market feels like and then what the final number says is where most bad decisions happen. So what do these colorful boxes even actually track? So Callan is using a standard index proxies for each of these categories. So large cap is proxied by the S&P 500, which most of us know. Small cap is proxied by the Russell 2000, and then developed ex-US is developed international markets like Europe and Japan, not including the US obviously. Emerging markets are countries like China, India, Brazil, and others. US fixed income is a broad US bond index. High yield is lower credit quality corporate bonds, and then global ex-US fixed income is bonds outside of the US. Real estate is REITs or real estate investment trust, and cash here is short-term treasury bills. And again, if you want the exact index definitions word for word, I'll link them in the description below. But the crucial point here is that this isn't some random strategy backtest with hypotheticals. This is a reality check across major markets over time. So what can it teach us about investing to make us better investors? So let's use 2025 as the anchor and then we will zoom out. So here's 2025's returns top to bottom. Emerging markets returned 33.57%. Developed ex-US returned 31.85%, US large cap 17.88%, US small cap 12.81%, real estate 9.58%, global ex-USA bonds 8.85%, high yield 8.62%, US bonds 7.3%, cash 4.18%. So here's the first insight. In the same exact year, different investors experienced totally different emotions depending on what they owned. If you were heavy emerging markets or international, 2025 felt incredible. If you were heavy US stocks, it still felt good. And if you were heavy cash, as usual, it felt safe, but you also felt like you watched everyone else sprint while you walked. Same year, different lived experience. And when investing becomes about feelings instead of rules, people start chasing. So let's zoom out and pull out some of the real lessons here, because the true power of this chart is the pattern across time, not just one year. Our first major insight is this: leadership rotates. The top box changes year to year and sometimes dramatically, as you can see. And that means something practical. If you build your portfolio around what just worked, you're usually arriving late. So buying comfort is not the same thing as getting into opportunity. And here's what I want you to notice. Rotation doesn't only happen in crashes. Rotation happens even in normal years. So before we talk about 2008 and 2009, I want to show you a normal year and that still proves this point. So let's go ahead and look at 2013. This is not a crisis year. This is not 2008, 2009. This is not a rebound from the end of the world type year. And yet the spread is huge. US small cap returned 38.82%, large caps returned 32.39%, developed international returned about 21%. So yeah, equities crushed it. Now look at the categories that a lot of people assume should behave a certain way. US bonds returned -2%. Global ex-US bonds returned -3%. Emerging markets returned -2.6%. So even in a normal year, some big categories were negative while others ripped. And that's the first lesson we're going to take away here. Even when the headlines feel normal, leadership still rotates. Some areas rip, some lag, and of course some will go negative. And that's why diversification isn't about being right, it's about not needing to be right every single year. So if your expectation is my favorite thing should win every year, that expectation is a real risk to long-term results. And this chart proves it. Now here's insight number 2. This chart teaches the difference between absolute return and relative return. Sometimes the best performing box is up huge, and sometimes the best performing box is just less bad. A perfect example is 2015. So in 2015, US large caps returned 1.38%. That's not a typo. That was near the top of the leaderboard. So the winner wasn't a rocket ship. It just barely scraped by in what was basically a quiet year. And I remember in 2015 hearing people say, hey, we need to rethink investing from the ground up because something isn't right here. But this chart shows why that is pretty dangerous advice. Overhauling your strategy based on 1 year's performance is the fastest way to wreck long-term results, or pretty fast. So if someone says, hey, I want to try to pick the winner every year, this chart is going to ask you, okay, do you mean the year that the winner is 1.38%? Because that's sometimes what winning looks like on a broad category basis in a relative matter. So this is why chasing the top box can be a trap. Now with that foundation, let's go to the years and explain investor behavior better than any lecture ever could. If you want to understand why investors panic and sell, and then why they miss rebounds, and why they'll swear off investing right before it works, study 2008 and 2009. In 2008, US large caps are down 37%. US small caps down 33.79%. Developed international down 43.56%. Emerging markets down 53.33%. Real estate down 48.21%. High yield down 26.1%. This is not just volatility. That feels like the world is breaking. So what do people do? They reach for certainty. They sell. They retreat into what feels safe in the moment. And the chart shows you what safe looked like that year. US bonds are up 5.24%. Global ex-US bonds were up 4.39%, and cash was up 2.06%. Now watch what happens in 2009. In 2009, emerging markets are up 78.51%, high yield up 58.21%, real estate up 37.13%, developed international up 33.67%, and US small cap up 21.17%. Followed by US large cap up 26%, and cash was only up 0.21% that year. Here's the lesson, and I want you to actually hear it. The market tends to move up before your emotions recover. The rebound often starts while people still feel like the crisis is happening. Remember, calendar year returns can hide how violent a year felt in real time. A perfect example is 2022. The market had a historic plunge and still finished stronger than most people expected. That's why emotions and end of year numbers often don't match. This is also why time in the market may seem so attractive. It's not that people are dumb, it's that fear feels responsible. And the chart is telling you, fear is often late. Now let me hit you with 3 common mistakes that this chart exposes. Mistake number 1, calling yourself diversified when it's all one flavor of risk. Like, I own a bunch of funds, but they're all basically the same kind of exposure and they move together. You need to understand the funds that you're investing in and the underlying risk that they are associated with. Mistake number 2, selling after the worst year and then missing the rebound year. 2008 and 2009 are the loudest proof of that. And it's one of the most devastating mistakes investors make, and it can derail a plan for years. Mistake number 3, believing one simple rule always holds. Like bonds will always protect you. Sometimes that's true, and then sometimes that's not true. But markets don't sign contracts, and this chart is proof that what works today may not work tomorrow. That's where diversification comes in. This brings us to the year that broke a lot of people's brains, 2022. In 2022, US large caps are down 18%, US small caps down 20%, developed international down 14%, emerging markets down 20%, real estate down 25%, and bonds weren't a get out of jail free card that year. US bonds returned negative 13%, global ex-US bonds negative 18%, and high yield negative 11%. Cash though, slightly up at 1.46%. Now listen carefully, because this is a crucial investing point. The lesson of 2022 is not that diversification failed. The lesson is not that bonds are useless. The lesson is this: diversification is risk management, not pain prevention. A diversified portfolio is designed to reduce the chance that one single bet destroys your plan. It is not designed to guarantee you that every year is going to feel good. So if your portfolio philosophy is based on one simplistic relationship always working, this chart is telling you that's fragility, not strategy. So what do you actually do with this chart? Do not use this chart to try to pick next year's winners. That's not the point. Use it as a behavior filter so you don't self-sabotage. Here's 3 quick rules to remember. Rule 1, expect rotation. If you expect leadership to rotate, you stop being shocked when your favorite asset class has a bad year, and eventually will. You stop interpreting a down year as proof that you were forever wrong. You just see it as part of the market cycle. And that's what it is. Rule 2, build for survival. Most people build portfolios for the best case scenario, but this chart is a reminder that you also need a portfolio that can survive emotionally in the worst case scenario. Because the best portfolio on paper is useless if it makes you quit at the bottom of the market. And rule number 3, rebalance with rules. This is the boring superpower. Rebalancing is how you stop your portfolio from turning into one giant bet after a hot streak. Here's a simple example. Say you're a 70-30 investor, 70% stocks, 30% bonds. If stocks run up and your portfolio drifts to 80-20, rebalancing is selling a little bit of stocks and buying bonds to get back to 70-30. No predictions, no I think stocks are going to crash, just maintenance. And maintenance is what allows compounding to actually happen for real people. Because the biggest enemy is not often volatility, it's the decision you make when volatility shows up. Here's an exercise I want you to do. Pick one asset class, one color on the chart, and track it across the full 20 years. Don't look for it at the top. Look for how often it moves. And then ask yourself one honest question. If I owned that one thing, could I realistically hold it through the years when it's at the bottom? If the honest answer is no, that doesn't mean you're weak. It means your portfolio is mismatched to your temperament, and temperament matters more than hot takes. Let's wrap up with 5 lines that you can easily remember. Number 1, the winner rotates. Number 2, a normal year still has big differences across categories. 2013 proved that. 3, sometimes the winner is huge, and sometimes the winner is 1.38%. 2015 proved that. 4, crashes teach people fear. 2008 proved that. And number 5, rebounds punish market timers. 2009 and 2020 proved that. So don't try to build a portfolio that's going to try to predict what the next top box is going to be. Build one that can survive when you're wrong and keep you in the market for the long haul. And if you're seeing nonstop hype videos about last year's top box, that's usually your warning sign that performance chasing is already underway. Now, I want to hear from you. Which year on this chart would have messed with your head the most? Was it 2008 with almost everything collapsing? Or was it 2009 when the rebound exploded after and you missed the bounce? Or was it 2022 when even bonds were down? Drop your answer in the comments below. And again, thank you so much for watching, and I'll catch you in the next one.